My name is Nate Tan. I have myself and Kevin, aka Mech, and Neek. We all are members of Freedom Infinite Growth Investments, which is also known as FIG Investments, which is an investment club that's focused on not only generating capital individually, but community investing so that in the long term, we can reinvest those funds into our community and start building it up from the ground up, right? Today's conversation is going to be focused on should I invest into the market now? I know me, myself, and within my circle of friends, and of course within FIG, we've been having multiple conversations about what's been going on in the market, what's been going on as relates to coronavirus and how it's affecting our economy, our global economy, and how we can potentially take advantage of it. Um, so, before we move forward, though, we do have to let you know this conversation today is. I apologize. This conversation today is for information purposes only. We do not provide financial advice. And when you are involved in any type of investment that does associate risk, so please keep that in mind. And also, past performances do not guarantee future results or future returns. Before you take any action, we do encourage you to speak with a licensed professional so that you can have some professional guidance throughout your investment journey. So, for today's conversation, we're going to speak about the opportunity cost as it relates to investing, the pros and cons as it relates to investing now, and as it relates to going back to opportunity costs, we are going to highlight both on a tax standpoint and a time value standpoint too as well. We're also going to associate the risk levels and looking at the sector rotation in relation to the market cycles too as well. Now, some of these concepts are foreign to you. We understand that. Not many people have the same similar investment background or financial education or experience. So we do encourage you to watch our previous webinar, which is titled "What is the Market?" It will give you a strong foundation into our conversation today and a little bit more about who we are as far as FIG investments and how you can personally take advantage of that education. But once again, this is just strictly for educational purposes. So let's get right into it. Now, when it comes to the opportunity cost, one of the biggest things you want to understand is whenever it comes to building wealth, whether it be through investing, real estate investing, just having your own business or whatever, one of the biggest things you want to know is how to understand the tax code, right? Because as you make money, Uncle Sam's always going to be there. So let's take a look at what that looks like on an individual standpoint. This is 2019's federal income tax brackets. It's pretty self-explanatory, but a lot of folks are familiar with what that potentially means, especially now that it's tax season. But let's break down how that actually affects your income, right? So this is an example of an individual who has $50,000 of annual taxable income, right? And so essentially how that breaks down is you have from 0 to 9,700, that's taxed at 10%. Anything above that up to $39,475 is taxed at 12%. And for this example, up to 50,000 will be taxed at 22%. So what the age-old game is, how can you generate money but bring down your taxable income so you're not spending as much on taxes and keeping more in your pocket? What a lot of wealthy folks do is not only take advantage of various accounts, but they also take advantage of what's known as capital gains tax. So this is an example of what capital gains tax has been over the years. And historically speaking, it has always maintained a lower rate than your individual income tax rate, right? So essentially, they tell what does that mean? What does capital gains tax mean? So essentially, when you invest to the market, well, let's break it down. So let's say you invest to the market and you bought 100 shares of XYZ company, right? And at $20. So essentially, you put $2,000 into the market and you're expecting a return, which you actually get. You actually sell these shares at $50 a share, meaning that you profited $30 per share, which means your capital gain it has been $3,000, right? Now that portion is what the government can actually tax you on, and they'll actually tax you at 15% in this example, which means they take away $450. It means you profit $2,550, meaning your actual money that you put into your account, or at least your pocket, is going to be $4,550, right? So why is that of importance is because when it comes to capital gains tax, that's how your investments are more or less taxed when you sell them, Now, I do have to emphasize this is for long-term capital gains tax, meaning you've held an investment for over a year and a day. If you held an investment lesser than that time period, it will be considered normal income and will be taxed at that federal income tax rate. And as it stands today, capital gains max, meaning the maximum you can be taxed is 20%. And for federal income tax, the maximum you can be taxed is 37%. But of course, at that point, you have to make it over $500,000. And if you're doing that, you're probably making more than that because you already spoke with your tax attorney to bring that taxable income down. Right now, majority of folks are using their retirement portfolios to invest into the market, and some folks aren't even familiar that that's even happening. Your retirement portfolios are connected to the market, whether it's a 401k, a 403b, or a TSP. Majority of them are connected to the market. A quick fun fact, if your company is matching or providing a match, we encourage that you do take advantage of that, at least to the maximum that they're willing to match you with, unless that doesn't make sense for you on a personal financial standpoint, and that's for you to make that decision. Now, with the retirement accounts, they're what's known as deferred accounts, meaning the money that you put into that account is not taxed until you actually withdraw the funds. And Tim, what does that mean? Well, let me break that down a little further. So let's say you have your income, right? Before you get your paycheck, a portion of that goes to your retirement funds. And then whatever's left over, that's what's known as your taxable income, right? And that's where you see those additional deductions as far as your federal, state taxes, Medicare, Medicaid, et cetera, et cetera. And then you have your paycheck, right? So in the event that you actually need to have access to these funds, which a majority of them are reserved for retirement, you still can withdraw the funds from your portfolios. However, there is a 10% penalty that's associated with it if you're under the age of 59 and a half, as well as there is the funds that you do generate will be taxed at your federal income rate too as well, right? So long story short, if you aren't familiar with the tax system, understand it, get with a tax attorney so that you can take full advantage of what you have been dealing with, whether you're a business owner, an investor, a real estate investor, whatever it is that you're personally doing on a financial standpoint, so you can keep as much money as you can in your pocket and start building wealth. And these are some of the concepts that we talk about within Fig Investments internally so that we're all taking advantage of those opportunities, right? And a couple fun facts about this year. Like I said, today is April 7th. April 9th, 2020. And as of today, they have extended the deadline for the federal tax filings till June 15th. There's no penalty if you choose to file after April 15th. And so you don't have to worry about that. Even if you do owe taxes too, you have until June 15th to take care of that. You also may be familiar with the federal stimulus bill that recently passed. And so that essentially is reflective of 2018's tax filings, right? Now, if you didn't file your taxes last year, unfortunately, you do not qualify. And if you did file your taxes last year, then what you would need to do, or at least need to have happen, is that your adjusted gross income, not necessarily how much money you made, but how much money the government's taxing you on, has to be less than $75,000 of last year, right? Now, of 2018, I apologize. Now, if you do exceed that amount, what essentially happens is you're not entitled to the whole $1,200 check, but for every $100 that you made over $75,000, that amount will be deducted by $5 from the check. So if you're making over six figures, unfortunately, you're just not eligible to receive any funds as of yet, right? So once again, speak with your tax preparer, get familiar with what's going on, and educate yourself so that you can take full advantage of those opportunities. Now, the big question, why is now a good time to buy, right? Well, before we can answer that, we have to look at what's been going on in the market historically. And what we're going to look at today is the SP 500, also known as Standard & Poor's 500 Index. This particular graph is reflective of 30 years of what's been happening in the market, right? And one of the biggest things that you can recognize here is that over time, the market is going up. Granted, there's some up and downs, in particular back in 2000 when we had the Y2K boom and everyone thought the world was going to end. I know I did. Even when I was a kid, I just keep hearing these things. And then also you have what folks might be more familiar with was 2008, the housing bubble and the effects there. And of course, what we're currently dealing with as it relates to not only the coronavirus, but the impacts of the global economy, right? And but what you also want to look into or look at, and let's look at the 20-year chart here. So this is the past 20 years. Once again, there has been some volatility in the market, meaning it's been going up and it's been going down, but more importantly, it has consistently gone up, right? So if you did invest your money 10 years ago, you would have made a sizable return today, even with the dip in the market. Now let's take an even further dive. This is actually 5 years of the S&P 500 and what's been going on here, right? Now, of course, what's been recently happening as far as within the S&P, but also the market itself, has truly affected the growth over the past few years. In particular, it's actually had a drop of basically erasing all of the past 3 years in the market. Now, what does that particularly mean? Meaning, you have the opportunity now to look at the past 3 years and really identify how each individual stock, meaning companies, have performed over those years, and more or less hit the reset button and try to make that happen again, right? So that's what's making folks really excited. Now, another piece of this is if you look at the past month alone, this is basically what's been going on. The S&P 500 has quote unquote recovered and it's looking like it's starting to have a bull run, meaning that the value within the S&P 500 is increasing. Once again, there still is volatility, but that is also what's getting folks really excited about this might be that opportunity to buy. Or what they're really looking for is this the bottom? Now, what that essentially means is if I take it a step back, on the lowest point of this graph is what is known as the bottom when we're going to a bear market, right? So when it hits the bottom, this basically happens. So that's why folks are really kind of, you may hear this a lot, like, is the market finally bottom? Is it going to bottom out, et cetera, et cetera? That's the reasoning behind it. But what we all know, things could change at any time, especially the news. So we just look at a couple of news headlines over the past few weeks alone and just see how things have truly changed. Since 1933, it surged as far as the Dow is concerned. But the next day, a news headline talking about a catapulting 2,100 points, and has it finally reached the bottom? And then we're talking about, once again, 3 years of the stock market gains, they basically have gone away. But then we also see that it's practically a steal for stocks right now, which is honestly very true for quality. I have to emphasize quality stocks right now, right? So, of course, you got to do your research. But also, we're looking at just 2 days ago, once again, more exciting news. The market rebound finally hit 23K. And we also are hearing some not so favorable news, right? The market totally unprepared for how long economies will take to normalize after coronavirus, right? This is the ripple effects, right? How is this going to affect not only our individual lives, but the economy long term? And even more drastic news. This is a brutal bear market, predicts nightmare of 70% stock market crash, right? So have we really hit the bottom is one of the biggest things that folks are trying to understand and trying to get a gauge of. And so that's why it's important to, of course, do your research, look into the news of what's going on, but more importantly, know your risk levels and build your investment experience. Now let's talk about that. Knowing your risk levels is more so about knowing your risk tolerance, right? So this graph kind of depicts what that really means. So if you look at the bottom, it's the capacity to take risk versus the willingness to take on risk, right? So if you are an individual who has a lot of funds as far as discretionary income, maybe a couple thousand, even $1 million, then you have the capacity to take on more risk than an individual who might have $10 to $20 to invest, right? Even though their willingness might be very high, if they don't have enough discretionary income, they don't have the opportunity to take on more aggressive risks as somebody who has a lot more capital to work with, because once it's about recovery, right? So you can look at this graph and determine, are you a conservative, are you a moderate, or are you an aggressive person? Do you want to take on risk? Do you not want to take on risk? As more that you do take on risk, the more opportunity for you to have growth within the market. So there's a couple of vehicles that you can leverage to do that. Here's a couple examples. A money market account is very conservative. There still is some opportunity as far as interest gain within those accounts, but it's not as aggressive as, let's say, a growth or value stock. Also, we encourage you to look into bonds, ETFs, and also momentum stocks if you're someone who wants to, really take on that opportunity and try to make some quick money. Once again, there's still risk that's involved with that. And there is also excuse me, not it down, make sure we don't lose everybody. There's also an opportunity for you to make a sizable gain for yourself, but once again, know your risk tolerance, right? Now, invest in a safe environment has always been our one of our major rules here with NFIG Investments. One of the things we want to emphasize is you want to stick to what you know, not what you heard about. And I can't emphasize that enough. Odds are, if your friend told you about XYZ stock or XYZ company has been performing like this or whatever, 95% of the time you've already missed the mark because it's already happened. Everything is going to be happening real time. So time is of the essence when it comes to investing, right? But that's why it's important for you to research the companies that you're interested in, research their performance, research their historical performance, and research before you make any decisions so that you're well versed as to what's happening not only within that particular market, that particular sector, but what might potentially happen as far as your investment overall. Also, you want to pay attention to what your total gains and losses are over time, right? If your objective is to build wealth, this is very important for you. Of course, you don't want to lose money, but at the same time, you want to take full advantage of opportunities to gain money too and see how you're performing. Don't pay too much attention to the performance of your overall portfolio. Not saying that it's not important, but once again, if your focus is building wealth, then of course the dollar signs is what you want to focus on. Now, FOMO and SAFU, right? Fear of missing out versus situation all messed up. Everyone always has the FOMO experience. It's probably why you kind of jumped on this webinar today, because you know that this might be a golden opportunity for you to make a sizable return on some of your investments. But we do want to caution you because you don't want to, once again, be reactive rather than have a plan and a strategy so you don't get into a situation that's all messed up. And I don't think I really need to explain that piece a little further, but that's one of the major things that we wanted to take advantage of as within FIG Investments as an investment club, so that we can share in those experiences, share in the research, and then make sound decisions as a collective versus being the Lone Ranger and trying to figure it out ourselves, right? And one of the biggest things that you really want to focus on outside of just researching the companies is researching the market cycles, the sectors, and the rotation, right? And with that being said, I'm going to turn over to my main man, Kev, aka Mech. He's going to dive a little further deeper into that.
Awesome. Hey, thank you there, Nitan. And great presentation there. So, hey, welcome everyone. We're going to go over basically here the market cycles, sectors, and their rotation. And you turn to the next slide. So here we're going to build on the concepts we kind of learned and covered in a prior webinar we called What is the Stock Market? And that provided an overview of the economic, business, stock market, and the emotional cycle. Here we're going to combine how the S&P 500, along with the underlying sectors, also have a relationship with the movements of the economic and stock market cycles. As we mentioned before, if you haven't already had a chance, we'd like to ask for you to review that prior webinar and basically make sure you have a good understanding of those foundational concepts, and then rewatch this segment again so all this information covered here will be clear for you to understand. Now let's take a look at this chart that's displayed here, which shows the stock market cycle as represented by the red wave, and then the economic cycle is represented by the green wave. Notice how the red wave for the stock market leads the green wave for the economic business cycle. The reason being is that the stock market is said to have be forward looking, kind of like almost looking around a corner, or attempts to have 6 to 12 months visibility of how the economic cycle is anticipated to perform in the future. The line in the center marks where below that line, the economy is going into a contractionary phase, and then above the line is moving to an expansionary phase. You can see how the red wave for the stock market turns up and crosses the center line before the economic cycle turns up, and then similarly, the stock market cycle will turn down and cross below the center line before the economic cycle turns down. Now we can say that basically the stock market and economic business cycles move together through 4 stages. The first stage there is the market bottom, and investors essentially here in this stage have a mental state of pessimism, but are still hopeful that things will turn around for better tomorrow. You can kind of think of the adage, hey, hope for the best, but prepare for the worst. And you can see that the red wave of the stock market is at the bottom of the cycle, which is coming off a steep sell-off in the stock market. The economy is still contracting and in a full recession. The economic weakness favors loose monetary policy, which the Federal Reserve will then lower interest rates to help stimulate business activity, which is bullish for stocks. And then we go into the second stage. Due to the Fed lowering their interest rates, the stock market begins to anticipate an economic expansion phase and begins to rise and move into a bull market cycle. The mental state of investors turns to optimism, and the economic cycle moves through the trough, which signals the start of an early recovery. Next now, in the third stage, we see here that the economy is starting to show a vast improvement in its economic conditions. And as the business cycle prepares to move into an expansionary phase, stocks are starting to move towards the market top. The economic cycle is starting to make a full recovery, and it's in a period of full expansion. But in order for the Federal Reserve to combat the inflationary pressures that's occurring in the economy, they start to raise interest rates, and this puts pressure on the stock market once again. So now we go into the fourth stage. So after the stock market tops, it's anticipating another upcoming contraction in the economy, and business productivity and the profits will be in decline, which signals the start of that bear market phase. The extreme emotional state of fear starts to take over the market. And this also signals there's a peak now in the economic growth. And even though that expansion still continues, the economy is beginning to grow at a slower pace because the rising interest rates and the prices rising of the goods are starting to take their toll. By the time the economy is in an early recession, the stock market cycle is already forming a bottom again and is anticipating a lowering in the interest rates from the Federal Reserve, which will therefore stimulate the economy and start the cycle all over again from stage one, where you start at the market bottom. So next, this brings us up to the S&P 500 and the stock market cycles, or stock market sectors. During the last webinar, we discussed about the market indexes, and we covered the Dow, the S&P 500, and the Russell 2000. But also an important concept for investors to understand is how the stock market is also organized into different stock market sectors. One of America's largest stock market indices is the S&P 500, which serves as the de facto proxy for the financial industry to track its performance of the US stock market. In 1999, the S&P began to organize a collection of 500 companies, all publicly traded in the US stock market, based on certain criteria into 11 major sectors according to similarities with their core businesses. The S&P conducts an annual review to ensure that the structure of the sectors remains fully representative of today's global markets. Examining these sectors allows you to compare one business to its closest competitor. And as an investor, when considering maybe if you're going to purchase a certain stock, it's helpful to research it against its competitors, which the sectors of the S&P 500, the way they're organized, provides that convenience for you to make easy comparisons. On the right, you can see a diagram, which is called a market carpet, and it shows all 500 companies of the S&P 500 as grouped by those business similarities according to their market capitalization and respective to their sectors, and the color serves as a heat map, and which represents which ones are outperforming relatively stronger in green than the ones that are underperforming, which are colored in red. So now that brings us next to the economic stock market cycle and the sector rotation. In the center here, you see the globe with the word SPY on it, which symbolizes the exchange traded fund, AKA ETF for short, which is the broad market performance, and that's the red wave. Now, the broad market governs the general trend for all stocks. So it's important to understand that certain groups or certain sectors lead the market and certain sectors lag the market. The objective is to find which sectors have relative strength when the broad market conditions are bullish and which sectors have relative weaknesses when the broad market conditions are bearish. So in the market bottom stage, the technology sector, which is represented by the ETF XLK, basically is the one that's anticipating that the economy is going to rise again and is moving from that point from the market bottom to the bull market. The ETF for the exchange for the technology sector basically comprises the companies that's developing technological items or services that include ones like Microsoft, which makes operating systems, and advanced micro devices, which makes microprocessors like the ones that's going into the PlayStation 5. And then next we have the consumer discretionary sector, represented by the ETF XLY. The consumer discretionary sector primarily consists of discretionary consumer products, such as luxury items or services that are not necessary for survival. The demand for these items depend on economic conditions and the wealth of individuals. Products include cars, jewelry, sporting goods, electronic devices. Some of the companies in the sector you may recognize are Starbucks, Best Buy, and Amazon. And then under the bull market phase, we have the communication sector, which is represented by the ETF XLC. The communication sector ETF consists of companies that are like internet providers and cell phone plan providers. Some of the ones you may know in this sector are Netflix, Walt Disney Company, AT&T, and Facebook. And then also under the bull market stage next, we have the industrial sector, which is represented by the ETF XLI. The industrial sector comprises of a wide range of companies, from airlines to railroad companies to large military weapons manufacturers. Two of the largest industries here are the aerospace, defense, and construction and engineering. Some of the well-known companies in the sector are Delta Airlines, FedEx Corporation, and Boeing. And then next we have the materials sector, which is represented by the ETF XLB. These companies in the materials sector provide raw material needed for other sectors to function. You can think of mining companies here, which mine for gold and copper, and forestry companies that mine for like lumber. A well-known company here is the Dow Chemical Company that manufactures and supplies products that are used primarily for raw materials and manufactures other consumer products that are transported worldwide. And then now as we get to the top of the market cycle, where there's more relative strength, you see the energy sector, which is represented by the ETF XLE, start to outperform. The energy sector are ones you can almost kind of imagine. They play a part in oil, gas, and consumer fuels. Popular companies here you'll find are ExxonMobil and Chevron, and which basically support gas. And then you'll find other companies like Kinder Morgan, which actually transport fuel to the gas stations. So now at the market top, it becomes the tipping point, and where the leadership starts to shift from the energy and the market's on a downcline to consumer staples, which is represented by the ETF XLP. Consumer staple companies provide all those necessities that we actually need in life, such as you can think of like food, beverage companies, household products, and other personal items. Well-known companies here are ones like Procter & Gamble, which is famous for bleach and laundry detergent under the brand names of Dawn and Tide. Another one is like Kroger, which is like the largest supermarket chain in the US. And then also under this market top, going into the bear market stage, we have the healthcare sector represented by the XLV. The healthcare sector consists of companies that are offering medical supplies, or your large healthcare companies, and also those insurance companies. A familiar name here you might know of is like Johnson & Johnson, and who has like Tylenol, and other companies that might manufacture medical implant devices. Another large growing component of the healthcare sector are the cannabis companies that are rapidly growing. And ones you may be familiar with or maybe not familiar with are like Canopy Growth and Aurora Cannabis. And then next we have, going into the bear market territory, your utilities sector represented by the ETF XLU. And utility companies, of course, provide and generate electricity, water, and gas to our buildings and households. One company here is Duke Energy that actually generates and distributes electricity. And then you have also, other utility companies you can think, and also ones that produce renewable energy sources, such as ones like solar manufacturing companies. Next, we have the financial sector represented by the ETF XLF. And the financial sector includes all those companies involved in finance, investing, and pretty much the movement of storage of money. It includes the banks, credit card issuers, and credit unions, and those also insured companies. Companies in this sector you can think of are Bank of America, JP Morgan, Chase & Co., Goldman Sachs, American Express, of course, with the credit cards, and then a large multi-conglomerate, Berkshire Hathaway, led by the famous Warren Buffett. And then now at the bottom of the market, we get to the real estate sector, which is represented by the ETF XLRE. As the name suggests, this is one of the newest additions to the S&P, and it includes real estate management and real estate investment trust companies. One popular company here is American Tower REIT, which actually manages and leases land and space on building rooftops to cell phone companies that set up cell phone towers and antennas. So here is pretty much the overview of the economic cycle, the stock market cycle, and its relationship with the S&P 500 sectors and how those sectors all rotate through the 4 stages of the market. This pretty much concludes my portion of the webinar. We appreciate you for attending this, and I turn it back over to Nathan to close us out.
Thank you, Mac. I do appreciate that, man. A lot of great information that we just went over. I know some of it may be a little hard to capture. So what we actually did was record this webinar, and we will be posting on our YouTube channel. Once again, we do encourage you to watch the What is the Market. That video is up and running. We're actually going to post it up in this live feed here, so you have access to that. But also, we do encourage you to become a member. These are some of the in-depth conversations that we're going to be having internally, not just the high-level overview that we did today, but really diving into the meat and bones of this thing, so that we all can become financially successful. Once again, we encourage you to visit our website, find out more information about Fig Investments. The website is listed here, www.freedominfinitegrowth.com. Of course, we do encourage you to become a member so you get more in-depth information, but we will be producing webinars moving forward so that we can make sure that our folks are properly educated and giving them some foundation to build their investment portfolios, but also their wealth as individuals and as a family, and ultimately speaking, as a community. So with that being said, once again, I want to thank you for your time. Thank you for joining us today. Please tell your friends and your family what you learned today. Review all the information that was provided. Speak with a licensed professional before you make any financial decisions. And we'll look forward to seeing you next time. All right. Thank you so much. And we'll talk to you later.